Have you ever wondered if you're paying more taxes than you actually have to? Well, you probably are. Every single year, millions of Americans hand over way more money to the IRS than they legally owe. Not because they're doing anything wrong. Not because they're bad at math. They simply don't know what they're allowed to claim. And here's the crazy part. The IRS isn't going to send you a friendly email saying, "Hey, looks like you forgot a deduction. Here's your money back." Nope. If you don't claim it, they keep it. That's why today I'm showing you 7 tax deductions that thousands of Americans overlook every year. Some of these could save you a few $100. Others could save you thousands. Now, one quick thing before we jump in. I'm not your CPA, and tax rules can change over time, so always double check your own situation. But if even one of these applies to you, it could make a real difference. Alright, let's start with one that surprises a lot of people. Number 1, the home office deduction. If you work from home, stop scrolling for a second, because this one could be worth a lot more than you think. Now, before you get too excited, working from your kitchen table once a week doesn't count. The IRS wants to see a space that's used regularly and only for your business. It doesn't have to be an entire room. Maybe it's a small office. Maybe it's a corner of your basement. Maybe it's that extra bedroom you've turned into your workspace. If that's where you actually run your business, you may qualify. And here's why people love this deduction. You can write off part of the cost of your home. We're talking about things like rent, mortgage interest, electricity, internet, insurance, and even certain repairs. Think about that for a second. You're already paying those bills anyway. If part of your home is helping you earn money, why shouldn't part of those expenses reduce your taxes? Makes sense, right? Let's say your office takes up around 10% of your home. That could mean around 10% of certain home expenses become deductible. Depending on your situation, that could save you hundreds or even thousands every year. The biggest mistake people make? Trying to claim a room that's used for everything. If your office is also where your kids play video games every afternoon, yeah, that probably isn't going to fly, so keep your workspace dedicated to work. It's one of the easiest deductions to defend if you ever get asked about it. Number 2, health insurance for the self-employed. Now this next one is huge, especially if you're self-employed. Freelancing, running a small business, driving for Uber, selling online, doing contract work. If you pay for your own health insurance, listen up. Many self-employed Americans can deduct the full cost of their health insurance premiums. Not half, not a small percentage. The whole thing, as long as you qualify. Think about how expensive health insurance has become. For many families, it's one of the biggest bills they pay all year. So imagine being able to lower your taxable income just because you're paying for your own coverage. That's real money. Here's a simple example. Let's say you spend $8,000 a year on health insurance. If that amount qualifies as a deduction, you're reducing the income that gets taxed. And less taxable income usually means paying less tax. Pretty simple. Now, there is one important catch. If you're eligible to get health insurance through your spouse's employer, this deduction may not apply. That's why it's always worth checking the rules before filing. But if you're truly self-employed and paying your own premiums, don't overlook this one. A lot of people do. Number 3, education that helps you do your job. Let me ask you something. Have you ever paid for a course, bought professional training, or earned a certification to get better at the job you already have? If the answer is yes, you may have been able to deduct some of those costs. Here's the key. The education has to help you improve your current career, not train you for a completely different one. Let's say you're a graphic designer. You buy an advanced Photoshop course. That could qualify. Maybe you're an accountant studying for a professional certification. That could qualify too. But if you're an accountant deciding to go to medical school, that's a different story. The IRS generally doesn't allow deductions for education that prepares you for an entirely new profession. So what's included? Online classes, professional certifications, certain books, industry conferences, training programs, sometimes even travel connected to that training. If it's helping you become better at the work you already do, it's worth looking into. And honestly, this is one of those deductions people miss because they never even think about it. They pay for a course, finish it, move on with life. Meanwhile, they leave money sitting on the table. Don't be that person. Keep your receipts, save your invoices. You'll thank yourself later. Before we get to the next deduction, here's something a lot of people don't realize. Saving money on taxes isn't just about making more money. Sometimes it's about keeping more of what you've already earned. And that's exactly what the next deduction is all about. Because if you own a home in certain states, This one can get pretty interesting. Number 4, state and local taxes. All right, let's talk about a deduction that can make a pretty big difference if you live in a state with higher taxes. It's called the state and local tax deduction, or SALT for short. Now, I know, the name isn't exactly exciting, but the money behind it definitely is. If you qualify and you're itemizing your deductions, you may be able to deduct certain state income taxes and property taxes you paid during the year. For a lot of homeowners, that's already money they were paying anyway, so why not get a tax break for it? Here's the important part. There's currently a limit on how much you can deduct. That means not everyone gets to write off every dollar they paid. Still, many people qualify for a valuable deduction and never even realize it. If you own a home, pay state income taxes, or even paid sales tax in certain situations, it's worth taking a closer look, because ignoring it could mean leaving money behind for absolutely no reason. Number 5, charitable donations. Now here's one almost everybody has heard of, but a surprising number of people still misunderstand it. Donating to charity can reduce your taxes, but there's a catch. Not every donation automatically saves you money. To benefit from this deduction, many taxpayers need to itemize their deductions instead of taking the standard deduction. That sounds complicated, but here's the simple version. If your total deductions are higher than the standard deduction, itemizing may save you more. And if you're already itemizing, those donations suddenly become much more valuable. Cash donations count. Many donated household items can count too. Furniture, clothes, electronics, even certain vehicles. As long as you're donating to a qualified organization and keeping proper records. Here's one smart strategy. Instead of donating a little bit every single year, some people combine multiple years' worth of donations into one year. That increases their total deductions and may help them benefit from itemizing. It's a simple trick that's completely legal, and it can make your generosity work a little harder for your wallet. Number 6, investment losses. Okay, nobody likes losing money in the stock market. Trust me. But here's the silver lining. Sometimes those losses can actually help reduce your taxes. Let's say you bought shares of a company. Things didn't go as planned, and you sold them for less than you paid. Nobody celebrates that. But those losses may be used to offset certain investment gains. And in some situations, if your losses are bigger than your gains, you may even be able to reduce part of your ordinary taxable income, subject to IRS limits. That's why experienced investors don't just think about making money. They also think about when they sell. This strategy is often called tax loss harvesting. Sounds fancy, but really, it's just using the tax rules to soften the blow of an investment that didn't work out. The important thing is not to sell investments just because of taxes. Your investment decision should always come first. But if you already have losses, don't assume they're completely useless. They might actually help you at tax time. Number 7, student loan interest. If you're paying off student loans, don't skip this one, because many borrowers can deduct some of the interest they paid during the year. Notice I said interest, not the entire loan payment, just the interest portion. Even so, that deduction can still lower your taxable income. There are income limits and eligibility rules, so not everyone qualifies, but millions of Americans do. And here's the funny thing. People spend years making student loan payments without realizing that some of that interest could help reduce their taxes. If you're making those payments anyway, it's definitely worth checking. It only takes a few minutes, and those few minutes could save you real money. 3 quick bonus tips. Before you leave, I've got 3 quick tips that could save you even more. Bonus. Tip number 1. Know the difference between a tax deduction and a tax credit. People mix these up all the time. A deduction lowers the amount of income that's taxed. A tax credit lowers the amount of tax you actually owe, and dollar for dollar. Credits are usually even more valuable. So don't stop your research after looking for deductions. See if you qualify for credits too. Bonus tip number 2. If you're saving for retirement, pay attention to traditional retirement accounts. Depending on your situation, contributing to certain retirement plans may reduce your taxable income today while helping you build your future. That's what I call a win-win. Bonus. Tip number 3, keep good records. Seriously, this one isn't exciting, but it's probably the most important advice in this entire video. Save your receipts, download your statements, keep digital copies, write notes if you need to, because a deduction you can't prove isn't much of a deduction. Good records make tax season easier. They also make life much less stressful if you're ever asked to verify something. Final thoughts. Here's the truth. Most people spend hours trying to find ways to make more money. They'll work overtime, start side hustles, pick up extra shifts, and there's nothing wrong with that. But very few people spend even 30 minutes learning how to legally keep more of the money they've already earned. That's a mistake. You don't need secret loopholes. You don't need to be rich. And you definitely don't need to do anything shady. You just need to understand the rules. The tax code isn't designed to punish people who use it correctly. It's designed with deductions, credits, and incentives that reward certain activities. The problem is, most people never take the time to learn about them. So here's my challenge for you. Before you file your next tax return, spend 1 hour reviewing the deductions and credits you might qualify for. That single hour could end up being one of the highest paying hours of your entire year. If you enjoyed this video and learned something new, hit that like button and subscribe for more simple money tips that actually make a difference. And I want to hear from you. Which deduction surprised you the most? Drop it in the comments below. Thanks for watching, and I'll see you in the next one.